Okay, folks. So worldwide markets are currently selling off, and we need to understand why. We discussed a week ago how the new US economy is sending the globe into a spiral, and how by 2025 we might experience not only a currency crisis, but also a global asset meltdown. It's critical that we understand how storm clouds arise. Trump's trade war is causing widespread worry, and it is not limited to China. In 2025, US policies will have the greatest impact on G7 partners and their economies. The Federal Reserve has now indicated that interest rate decreases may come to an end this year. In a world where US interest rates must fall, this means calamity. It is especially true for economies that are over-leveraged, overspending, or experiencing stagnant growth. Now, the United Kingdom is the newest casualty. We are experiencing another low trust period, with the true motor of today's economy collapsing. And this is dangerous since other G7 members and rising countries are following. Britain's bond market is practically imploding. Long-term borrowing costs in the United Kingdom have reached their highest level since the 1990s. In other words, UK bond prices have fallen to a 25-year low, and investors have been burned. On the consumer level, yields have risen. If you have to borrow money to finance anything, you're basically screwed. The main problem Britain confronts is a breakdown of trust. When investors acquire bonds, they want the country's economy to expand so that they do not default. However, they also demand that government expenditure be managed so that the currency does not collapse. Well, the UK lacks all of those, and money is abandoning British assets. Government debt has reached its greatest level since the early 1960s. In fact, we're quickly nearing World War II levels. Debt to GDP is set to reach 100%, and unlike in the United States, the quantity of debt in the United Kingdom is far more significant. Demand for British bonds remains uncertain in the absence of US dollar support. The UK economy has practically stopped. Productivity has fallen, and government investment has also declined. Let's not forget about the exodus of cheap Russian energy. All of these factors contribute to the decimation of British industry. Now, does this sound like a familiar theme? Is the EU tale repackaged for the UK? Investors dislike the future prospects. Through 2029, British growth will be lower than the G7 average. The Western Bloc as a whole will expand at roughly 1.8%, whereas the United Kingdom will increase at only 1%. In truth, all of these estimates are quite optimistic. In contrast, the United States will expand at a rate of more than 2% of GDP. Sure, its growth is driven by deficit spending, but investors understand that even debt is more sustainable than in the UK due to the currency and the US consumer market. So financial power, or money, is abandoning ship today. If interest rates continue to rise, the UK's economic growth would suffer greatly. According to predictions, it will lower GDP growth this year by 0.3%. And for the markets, this is terrible news. It means the government will have to borrow and spend more, which could devalue the currency. Now, if British bonds yield 4%, but the pound falls by 4% or more, you will lose money. You could even lose money from the currency risk. There's another issue to consider. The percentage of UK foreign bond investors has increased to an unprecedented amount. In 2004, it was barely 15% of overall debt, and 20 years later, it is approximately 29%. These aren't local investors or British banks buying the bonds. These are foreign holders looking for a real return. The lower the currency falls, the greater the desire to liquidate their bond holdings. They aren't faithful here, and what we're witnessing is a result of US economic policies. As US interest rates remain high, and the currency appreciates. It serves as a wrecking ball for global debt markets. It does not discriminate. Money would move away from UK assets and toward US bonds. It's the classic safe haven trade, since no matter how insane things become, the US dollar remains the world's reserve currency. It is the baseline. However, this has far-reaching consequences for the United Kingdom and its people. This is where the story takes a tragic turn for the man on the street. Now, thanks to British bonds collapsing, mortgage rates in the UK could fly up to the moon in 2025. 700,000 borrowers will face higher monthly payments in the near future. This year alone, UK households will pay $1.2 billion to refinance their mortgages. The amount of bigger housing payments is starting to trend up once again. But what if rates continue to stay high? What if UK rates go even higher? That's going to demolish the middle class. What will you have left over at the end of the month if you've spent all of your money on mortgage payments? What Britain is facing is a rising dollar, reducing liquidity, and rising bond rates. Demand for British debt falls, and as a result, demand for the local currency decreases. This is why the pound has fallen back to its 2023 lows. In just 1 month, it has dropped by 4% against the dollar. The impact is now extending to people on Main Street. Imports will cost more, shopping at Harrods is pricier, and buying food will become quite expensive. This is the problem with the US currency system. When something goes wrong, it affects everyone. This will be a coordinated collapse, with the weakest economies being the first to show the damage. It's Friday and the markets are crashing hard. Yesterday, we discussed how rising rates pose a massive collapse risk and threaten assets. 2024 was an unbeatable year for stocks. We all saw huge profits, with the S&P recovering over 20% easily. However, the story will change in 2025, and we need to talk about how high US bond yields can go. The 30-year yield is above 5%, and the 10-year yield has officially surpassed 4.7%, heading toward 5%. Job data still shows a very strong outlook, with over 250,000 jobs created in December, providing the Federal Reserve with additional protection. The case for maintaining high interest rates remains solid. The key issue is how high bond rates can rise and how long they can stay there. Because if this continues for too long, it could push the globe into a recession. The markets would then fall even harder, especially considering how high valuations are now. We now only need to see how much money the Treasury will borrow this quarter, from January to March. Yellen and her successor will borrow $823 billion. That's a tsunami of bonds hitting the market, so the supply of treasuries is increasing, while the Federal Reserve refuses to lower interest rates. This is why bond yields are so high. The danger of global tariffs adds fuel to the inflation fire. When Trump decides to hit the globe, a few things are almost certain to happen. The US will suffer from a rising CPI, and prices on the shelves will increase. Domestic inflation in America may worsen significantly. Secondly, the flow of funds into the world will slow down. What happens now that the dollar is scarce? It boosts the dollar and devalues global currencies. Now the entire world, from Asia to Europe, is suffering from increased import costs. Global inflation rises, and the stock market collapses. The current situation could worsen significantly. Looking at customer expectations, we notice a problem. Americans expect prices to rise much higher than before. TPI will remain at 3.3% over the next 10 years, up 30 basis points. This is a significant challenge. The Federal Reserve's mission is to persuade people like you and me that inflation is not an issue. In other words, they want people's inflation expectations to decrease. In Powell's world, everything looks like a nail, and high borrowing rates, which serve as the hammer, are his only remaining tool. The chances of a significant rate drop in 2025 are slim to none, and Slim just left the building. There's another major reason why stocks are selling off so violently. The US economy is based on credit card spending. People swipe their plastic as if there's no tomorrow. However, if yearly interest rates stay high, defaults will increase, and banks will begin lending less. This is already happening. Outstanding credit card debt has decreased by about $14 billion, the biggest drop since the epidemic. People aren't spending anymore, and banks are reluctant to lend because credit cards have APRs of at least 22%. When bond rates rise, it's likely that those APRs will stay at or rise above that level. As a result, we have a daily cocktail of events affecting both the global and US economies. Nobody is immune to the upcoming train catastrophe. This playbook has been used repeatedly over the last few decades. Every time the dollar rises, it triggers a worldwide currency and bond crisis. However, this is not healthy for the United States or its hegemony if it reminds nations to break free from the system. This is why nations like Indonesia are joining BRICS. They want to rely less and less on the dollar system, instead trading in local currencies and borrowing more money outside of the USD. It's no accident that BRICS is growing. What's worrying is that even the United Kingdom is turning to China for help. As we've already said, the best way to reduce dependency on the United States is to increase trade with China. Rachel Reeves will meet with the Vice Premier in Beijing to push forward her agenda. Russia, Taiwan, and Hong Kong are now on the list, but they're just appetizers before the main course. What the UK actually wants is more commerce with China, especially as the US starts to pull inward. We may soon see the US importing fewer British goods. In addition, industries may leave Britain for the United States. Trump's tariffs could lead to a wave of deindustrialization in the UK, which is already happening.